it's really about going, okay, what does my portfolio need, right? And at times your portfolio is going to need growth, right? And maybe during those growth phases as well, you can stomach a little bit of negative cash flow. Because I would say as well, right? It's not all about cash flow, right? It is all about actually what is going to get you to your goal, right? As much as we talk about having, cash flow positive properties and everything, that's actually kind of like there's a bigger game that is being played, and that is, how do you get to your destination? How do you achieve a life of freedom, choice, and abundance? And what does that look like? And so one of the ways I think people can go wrong in this environment is looking at a property which is ostensibly a great property in a great area, which is going to grow fantastically, which ostensibly still has a really good yield, 5.5, 6.5, 7% yield or something like that, but may not be cash flow positive on P&I or some other factor like that. And therefore people go, well, it's not cash flow positive, ain't buying that. Thanks, interest rates. It's like, well, I think you probably need to look pragmatically at what the opportunity actually is there. When the national average yield is like 2 to 3%, right, and you're buying something that's like 5.5 to 6% or something like that, you've got to remember, like, actually, this is a unique opportunity, right? And so the environment has changed short term. That doesn't mean that you should reject good opportunities short term, because you should be playing a longer game. Back to the point that I made earlier, that asset may make you 50 grand in a year, but cost you $2,000 in negative cash flow, but you're still going to be $48,000 up, right? And so turning down $48,000 for the sake of turning down $50,000 for the sake of $2,000 is a really bad way to build wealth. Like, that just does not make any sense. But people can get fixated on short-term metrics without thinking about what the macro environment looks like. Because the other point that we've got to remember is that interest rates won't stay up forever. Historically speaking, they have gone up, and they've gone up plenty of times in the past. And they've gone up a lot in the past. There's been times where they've gone up 3, 4, 5, 6, 7% in a very short period of time, right? And I don't believe we're actually going to go that high, right? But they typically only go up for between a year and 2 years, which is why I'm so confident when I say I don't think we're going to have high interest rates in 2 years' time, right? So these things are short-term situations that people really need to consider. And then you can actually go, okay, well, what if that was the opportunity in front of me? If someone said, it's fairly, let me rephrase that. If I believed I had a fairly good, if I believed it was fairly likely that I would make a significant return over a 12-month period, but it may cost me short-term in cash, what would I need to adjust in other parts of my life or in other parts of my portfolio to make that decision still viable? Because I know that the upside is significantly better than the downside risk. And that's how I think people should be thinking about it. That comes down to cost of living stuff as well, which we can talk about in a minute.